Okay, so this is a live tutorial for investment appraisal, and I'm going to be going over a past investment appraisal question from March, June 2024, which is on the practice platform, and you can assign it to yourself. And there's two questions for March, June that were released. One was a financing question, which you'll be doing on revision probably. This one, which is an investment appraisal question. Now, this investment appraisal question has got three requirements. The first requirement is asking you to do for 12 marks a calculation. And that is pretty good, actually. 12 marks calculation. That's probably about the maximum you'll get from a question with calculation. The rest of the marks will be 8 marks, which will be going for writing. All right. Now, this question was do a calculation for on a nominal basis, as you can see, using a nominal terms approach for an investment appraisal project. Part B is asking you to write about how it would change if it was a real terms approach. And then part C is you haven't done yet, that's this week, is about simulation models. So let's have a look at what's going on. It says calculate the net present value under a nominal terms approach and comment on its financial acceptability. There is 1 mark for commenting, but it needs to be a full sentence. Okay, and I'll point that out when we do it. Nominal terms approach means use inflation and use the nominal rate of discount rate. Okay, so you have to use inflation in the cash flows and you discount at the nominal rate. Real means that you discount at the real rate and you need to deflate nominal cash flows to get to real cash flows. So we'll have a look at that in a minute. So let's go through the narrative. Elaan company, I might use a highlighter, so just check it's on, is a company appraising an investment project to purchase and operate a hotel. So think about a hotel, think about their revenue and their costs and how you would put them into a cash flow. Okay, so it's not a normal volume sell business. They're selling hotel rooms and they're selling meals in a restaurant. So they have basic accommodation and a restaurant. The hotel will be operated for a 4-year period and it's then going to be sold at the end of the 4 years. Now that isn't really reality, but they're telling us that. A suitable property has been located. So we're going to be paying 5.5 million. Now, remember, sometimes figures that are in the narrative need to be converted into either dollars or round thousands. Okay, so that says 5.5 million. If you're going to convert that into dollars, obviously you've got to make it 5500 and then another 3 zeros. If you're converting it into round thousands, you need to make it 5500. Right, so just be aware of how you do this in your exam. It required new fittings, which are expected to cost an additional 1.5 million. So therefore, we've got an initial investment going out of 5.5 plus 1.5. And in my head, hopefully, I can add that up and that makes 7. It's expected that once the property is purchased, the fittings can be installed quickly. So the new hotel will be ready for business immediately. So basically what they're saying is you're going to pay it out straight away. The hotel will have 50 rooms and can be open for 365 days a year. So we've got some forecasting assumptions. So room occupancy is pretty key in the hotel industry. So what they're saying is 50% of the rooms are going to be occupied in the first year, 60 seconds, 75, and then 90. And to calculate the revenue, you would need to know how many rooms there are available, which are rooms, and how many days in the year to get you the total number of rooms available times by the occupancy, which is given to you here, and then times by the room rate. And they're telling us the room rate is 85 for the first year. Now, first year, okay? That means the first year is 85. It doesn't say current price terms. That means the first year terms. Okay, so really read carefully. So your first inflation, which is going to be 6%, starts in year 2. All right. Now you're used to looking at calculations where it starts in year 0 and your first inflation is year 1. So really read it carefully. Restaurant revenue will be equivalent to 35% of accommodation revenue. So again, we need to add restaurant revenue to the accommodation revenue. Now, really focus on this. It's important that if you get that first year wrong, do not stress. Do not have a stress when you come out the exam, because there's loads of follow-through marks. You're going to just lose half a mark for that. Don't worry about it. But you do, if you then let that put you off the rest of the paper, then that's your problem. But you just need to move on and work out that you are going to get follow-through marks if you put that as the first inflation as being 0 in the first year, effectively. So let's start putting this into my analysis, and then we'll work down. So at the moment, we've been told we've got some base volume. So we're going to base the volume on equals 365 days a year times by, we need to do the times figure, 50 rooms. That's our base volume. Okay. So that's our base volume. And so we're going to use that, and it's going to be in the first year, and it's going to continue from then on. So just copy it across. Easiest way to get it in. We've got 4-year time horizon. Room occupancy I've put in already, and therefore we're going to be forecasting our volumes to be the occupancy rate times by the room availability. We now need to forecast our sales price. And remember, it's going to be with a 6% inflation. So pop that in so they know that you know that. And the first year is going to be 85. Now to inflate that up, we times that by 1.06. Make sure you put it in correctly. And notice I'm doing everything in the cells so they can see what I'm using as an inflation rate. And if I put the wrong one in, they can say, right, okay, you can get half a mark for inflating it, but you can't get half a mark for the full inflation, correct one. Now, obviously, the easiest way now, if you've only got one rate of inflation and one price, is just to continue inflating it up like this. But if you have changing prices each year, then you need to inflate it differently. You need to inflate it like this. You need to say equals, just so we know, equals 85 times by 1.06 and uplift to the number of years that it's going to be. Now, in this question, because we're starting year 1, it's not going to equal the number of years as in 4. It'll be 3 more years inflation because it's 1, 2, 3. Again, it really is all about understanding what you're actually doing, I'm afraid. And this examiner does type to trick you. So I tend to put that down to that number of decimal places because I don't like seeing too many decimals and it confuses me when I start marking. So I can look in the cells and check that you've done everything correctly. So I'm happy with that. So therefore, we are now going to times to get the restaurant to get the room revenue. You'd be forgiven for thinking you're doing a PM exam, by the way, everybody, but you're not. You're doing a FM exam. And therefore, we get nice figures like that. Again, I just put it back into a nice format so I can see it clearly. I'm doing everything in dollars and not round thousands because I just think it's easier. You just need to make sure you put everything in dollars so that you're clear. All right. Now, remember, 35% of revenue is restaurant revenue. So I'm going to put now restaurant revenue as in 35%. So I'm adding it to that times 0.35. Copy it across. And then put it down so you can see it. So therefore, our total revenue, which is going to be an addition of that plus that. Now you could have all times room revenue by 1.35 if you wanted to be slightly quicker, but I'm not that bothered. Now, you may find it easier to do this for that section afterwards, okay, to get the format looking the same. So that's our revenue. So that's our first line that we needed. I tend to highlight things so I can see as I go. So that's my first line I need is total revenue. So hopefully I get some marks for that, doing that correctly. Now I need to look at what's going on here. I've got variable costs expected to be 20% of total revenue and incremental fixed costs expected to be in dollars. Nice, thank you. 433 for the first year. They're both first years, remember, so it matches what's going on with sales. And they're going to increase by 4% a year thereafter. Now, that's not the variable costs, that's the fixed costs only. So I've got a question. How many marks would you get for that revenue count? 2 marks, probably. I need to check the marking scheme. I've forgotten to check, but I'm pretty certain it would be 2 marks. I'll have a look at the marking scheme and if I can find it in a minute. Right, so while I'm doing that, I'm going to put in my variable costs and my fixed costs. And I'm going to remember that's 20% of revenue, and that is going to be 4% inflation. So my variable costs, very easy. I would do this, I'd minus it, I'd times by minus 0.2 to get it into a minus. Calculate that across. I put this in as minus 433,000. And then I'd reference that and times that by 1.04. And copy that across because it automatically times it up by 4%. Just so you can see how that's working. Everybody happy that they've got that correct? Yeah. So now I'm then going to sum this down. So if you put minuses in, then obviously you've got to sum it down. If you haven't put minuses in, then you've obviously got to add and take away. So just be aware of what you're doing. Don't just blindly copy what I'm doing. So now I've got my trading income. So I've done everything down to that point. I haven't put in my investment yet. So I'm going to put that in after my tax benefits and my operating tax. But basically my investment is going to go in this point and my sale value is going to go there. We'll come back to that in a minute. But Elaan company pays corporation tax at 20% per year and tax is paid in the same year. Now, sometimes we see that in arrears and that means you'd be going 1 more year for tax, but you're not. So normally in some exams, you'll be saying this is for tax. 1 more year, but in this exam, it's in the same year. So this question, it's in the same year, so we're not. So operating tax, going to put it in as 20%. So literally going to do times by, sorry, try again. So that times by minus 20. You can actually write in 20% as well, or 0.2, whichever way you want to do it. And it automatically goes as an outflow. And that would get 1 mark. And then we've got the tax benefits to do, which we would do in a working. So that'd be my working 1. So the purchase of the property is not eligible for tax relief, but the fittings will be eligible for tax allowed depreciation at 25%. At 20% of them, tax benefits. All right. So you find 25% and then take 20% on a reducing balance basis. Okay, so then we go down to the tax benefits. Now, there's various ways of doing these tax benefits, but if you're doing it in an Excel spreadsheet, this is quite a quick way of doing it, just so you can see. It's a reducing balance basis. It's not on the 5.5, it's on the 1.5 million. So I put 1.5 million in there, which is the initial. We're going to get 25% of that as a writing down allowance in the first year, which is when it comes. Do not worry that it's always going to be in the first year, but the tax timing could be in year 2 if it's tax in arrears, but it's in the year. So we're keeping everything in the year. So that's the tax writing down allowance. And then the tax rate is 20%. So we're going to take that times by 20%. And because it's a benefit, remember, it's always a positive. And if you do it this way, it's actually easy now to equally just pop that in there. Now, what we then start doing, we get the initial amount, and then it becomes slash the written down value. Okay, so that's where it now at year 2 becomes the written down value. And the way you do this is you take the previous value, take off the 375, and that's now the new reducing balance value. You can then start copying this across. Copy it across to the end, but then we might be adjusting the end. All right, just so you're clear. You can then copy this across to the top, and you'll see automatically you're going to get 25% of that, and then 20% of that. And the same happens again. You now get another reducing balance, and you get 25% of that, and then 20% of that. But in year 4, we are going to have a balancing allowance because they've told us down here what our expected sales are. So we can't finish this off until we have read that bit. And it says the expected sale value of the property at the end of year 4 is expected to be 7.5 after tax, and the fixtures and fittings can be sold for an additional 100,000. So we've got a balancing allowance. Okay, so the balancing allowance needs to come, is basically not going to be 25%. It's going to be the full amount, okay, less the disposal value. Okay, that's where we get that. So it's going to be less 100K. That figure, just so we're clear. Right, so you're happy with that. So the final year, you get a balancing allowance, not a writing down allowance of 25%. And then automatically you take 20% of that. So that's how that works. Okay. And as you've referenced that in properly up there, you can then copy that across and automatically those figures will go in. Let's now make sure we put our sales value in our investment. Our investment is 7 million. You must put it as a minus though, and check you've got the right number of minuses. So sometimes it's better to zeros. So it's better to then put a minus in that and just check you've got 7 million. And the resale value we've been told is 7.5 plus 100. So you can put it in as 7500123 and then put it in the 100,000. So they know that you put both in, and you should add to 7.6 million. So that's everything done down there. And then we've got this awful working capital, which nobody likes. So let's show you how to do working capital. So working capital is working 2. And it says working capital equivalent to 5% of total revenue is required at the start of each year, and it will be released at the end of year 4. So because they're closing down the project, it will be released. Sometimes if they're not closing down the project, it says it's not going to be released because the project might be continuing. You just need to read the question. If it doesn't mention anything about releasing the working capital, assume that it releases. All right. Assumption is always that it releases because that's the default. Okay. So working capital needs to be 5% of revenue. So we're going to do it down here. And then we're going to reference 5% of revenue. So what you need to do, what we need is 5% of revenue in year 0 to make those sales. Okay. So first of all, you reference up your revenue. So we have a total revenue and we times it by 0.05, sorry. Try again. Okay, so we times by 0.05. So that's what we need. Again, I don't like my thing, so I'm going to do that. And we copy that across for the whole 4 years. Now, if you get confused, people like to see the years so that they can check that they're doing it correctly. You can always just copy down those years, like I have for the tax benefits, so you can see it clearly. So we need 52 in year 1 to make those sales in year 1. So that needs to be in place at the beginning of the year. So you go minus that, okay? So that full amount needs to be in place. Now, at the beginning of year 1, for year 2, we need an increment between those two. We don't need that. We need that in total, but we need to add the difference between those two because we're adding it to the 52. So it's incremental increases in working capital, all right? Because working capital doesn't get released. It builds with sales and then gets released at the end of the project. So what you do is you need to do this function. You need to go minus, because it's always going to be minus. And that's how it works, because if it reduces it, then it'll become a positive. So I'll show you that in a minute. You see, what we need in year 2 minus what we've got in year 1 gives us the difference. And then it'll be an increase by putting a minus in front of that bracket. So automatically, therefore, and you'll see if you show those two together, you add them together, you'll get to 66. If you've now put that in, then that's the formula you need going forward. So you click on that and you pull it, and therefore you'll see that the increments happen. And then at the end of year 4, because in year 5, you've closed the project and you don't need anything, that figure is referencing year 5. So you'll see it automatically shows you how much is coming back in. And by the way, it's always the same as what's in at the end of the year. So absolutely work really carefully and you'll understand how that works. Now, if you add these across, they should sum to 0. So then you know you've definitely got it right. So if we sum that across, it should sum to 0. And there it does. Yeah. Just so you can see it, sum to 0 as a check. So now we've got a working capital flow. So you just reference that down. So we need minus 52 there. Pop it in as that, and then copy it across. And automatically, you've got a wonderful working capital flows which reference in, and you'll get hopefully all the workings that you require. I've already put my sum in. Now, really carefully, do not sum up to revenue, right? That means you'll be double counting. You only sum up to trading income because you've already done a sum to trading income. Okay. So your total cash flows are then summed across. And you therefore then have your total cash flows. Now, you can now either use the net present value function. Let's just get rid of that. You can now either use the net present value function or you can use the discount factors. So if you wanted to use the discount factors, you can just pop them in as a line and then obviously use the tables. So you can use the tables, which are here. I just think it's much quicker to use the formula sheet. Just find you the tables. It's much quicker to use your either the formula in the cell or the net present value formula to do this, okay, in a spreadsheet. You would only really use these tables if you were doing a CQ and they're asking you to do it in an MCQ because they would be using the tables for that, all right? So how do we find the net present value? Well, we need to find our discount rate. And this is the trick. Here, down here, it says the real after-tax cost of capital is 4.8%. The general rate of inflation is expected to be constant at 5%. You can't use the 4.8% because that's the real rate. We need the nominal rate. So in order to convert from the real rate to the nominal rate, we have to use this Fisher formula here, which is 1 plus the nominal rate equals 1 plus the real rate times 1 plus the inflation rate. Okay. So we're going to pop that into our down here, which is our nominal rate. So inflation is 5%. The real rate is 4.8%. And so the nominal rate, okay, let's just check this, is the combination of two. So you make that 1.05, you make that 1.048, and therefore the nominal is going to be that times by that. And then the nominal rate is therefore that minus 1, which is 10%. So we're going to make it a percentage, equals that. And if you do the percentage button, it'll give you a percentage. Now, I know it's not exact, can you see, because you've got all those decimals, but you have to make it to the nearest number so you can use the tables. So we're going to use 10%. So 10% is there. That's why we're using that 10%. And now, how do we use the net present value function? Well, the net present value function finds the present value. So type it in, net present value. Finds the present value at 10%. Now, you can literally write in 10% of the cash flows from years 1 onwards, not year 0. That's not discounted. So it's year 1 onwards. So you calculate the total cash flows from year 1 onwards, close the button, and you have to type this in. Okay, so you have to learn the formula and learn how to use it. And therefore you get 7421109. To get the net present value, you need to take the 714219 and minus, or actually plus in this case, because it's already a minus, the total cash flows at time 0. So it's the net present value function, just so you've got it, plus the negative cash flows at time 0. So that's how you know what that is. And so our net present value is 368,754. Don't forget, it said comment on the financial acceptability. So I've written a comment next to it, labeled it comment, written it. The net present value of the project is positive, so financially acceptable. If any person writes positive, accept, you'll get 0. You need to write in a sentence and explain it. Positive accept does not tell me why. It said positive does not tell me why you're accepting it. It says the net present value of the project is positive, therefore financially accept it. That's exactly what the examiner wants. You cannot just write a little accept. I need to know why. Okay. So somebody asked me where all the marks are going. So let me just try and find that. Let's go through. So everybody wants to know how many marks they're going to get. So the total room nights, you're going to get 1 mark. Let's put this in red. The total revenue, you're going to get 1 mark. So I did say 2 for that. And that will be an own figure mark. All right. So let's just copy this. That's easier. Oh no, the total room rate revenue, that's 1 mark. For this one, it's not 1 mark, it's half a mark. Variable costs is also half a mark because it's not very much to do that. And fixed costs is 1 mark. So you can see how you're building these up. And these are all, so these are own figure rule marks, aren't they? The restaurant revenue and the room revenue, and obviously the variable cost revenue. So if you get it wrong up here, the forecast, then everything else is a follow through. Then we've got tax on cash flow. As I said, that would be 1 mark. We got TADS, and then the TAD benefits. So that's going to be 1 mark, 2 marks for those two. You've got working capital balance and working capital cash flow. That's 1 mark and 1 mark. You don't get any marks for these, right? So if you get them wrong, there's no negative marking, but you don't get any marks for them, all right? This is therefore now a nominal cost of capital. Getting the 10% is 1 mark. And finding the net present value is 1 mark. And that's an own figure rule mark. Whatever rate you've used, that will be a mark if you've used your rate correctly. And then the comment is 1 mark. So hopefully that's clear. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Fantastic. Does everybody get that? Have I got any questions? Do you feel that's doable? Anybody? Very doable. That's good, Jake. That nice and positive. So it's just practice and layout and systematic. Yeah, but actually, Sarah, I know it's a lot in one question, but it's 12 marks. So if you didn't have working capital, it would be 10 marks, for instance. Yeah. If you didn't have to inflate those fixed costs, that would be getting out another mark would have gone. Yeah. So it's actually better to have a lot in one question because you're building up lots more marks, I think, personally. Yeah. Yeah, and it needs practicing. Brilliant. Okay, so what I want to now do is what would we do if they asked us to do it the real way? They haven't asked us to do that, but let's show. I've got it over here. What would they ask us to do if they did it the real way? So if you were asked to do it the real way, okay, this is the real way. Okay, if they said do it the real way, let me just move this over. They ask you to do it the real way. What you need to do is deflate the nominal cash flows. So if we reference those nominal cash flows, okay, you deflate the nominals, which is what you would have done in your Pinks question. And how do you deflate them? Well, you deflate them at the 5% inflation rate. So what we need to do is obviously you don't need to deflate number 1 because it's times 0, so there's no inflation. But this one, the deflation rate will be 1.05 for 1 year. This is going to be equals 1.05 for 2 years. And you can copy that across so you get all the inflation rates for this 4 years. So deflation, deflation, deflation. Okay. Now, somebody's going to say to me, they said inflation, they've given us it for the first year. I think that's irrelevant. You've still got inflation going on in that first year. All right. It's just already included in that 85. So you've got to still stick with the rules that this is inflating in the first year. So you've got to deflate that first year back by 1.05. So therefore the real flows is therefore going to be that figure divided by that figure because you're discounting it back now, not compounding it up. And if we make it look nice again, you copy that across. So you've deflated the nominal cash flows and then you're going to find the net present value at the real rate. So at the real rate. So I've just done this in a quick way, all right? So that's my point. I've just done it in a quick way. So the net present value function. Oh, sorry, I'm going to move it over here. That doesn't work. So you're going to put in the net present value again, but this time you're going to use 4.8%. And again, don't forget the cash flows from 1 to 4. Close it off. Make it look nice. And then obviously now add those two together to get the real net present value of 358,877. 358,877. Just going to get rid of this because it's not liking me. Let me just see if that's the same as what I got previously. Now I've done a simple calculation there. In reality, right? In reality, I have deflated all the cash flows. So including the tax benefits and the working capital. Okay? So I've done all of that, and that's a simple way of doing it. In Pink's question, we just deflate the trading income and then leave these as inflated cash flows. But I've done the whole lot just to give you a simplified version of how we're going to get the real NPV. All right. So the real rate, if you use real flows and the real rate, you should effectively get the same net present value result as if you use the nominal rate and the nominal cash flows. So that's what the question was asking, which is over here. So you weren't required to do that, but I wanted to show you how you do it as a numerical. So you need to explain how the approach to the net present value appraisal in A would change if the real terms approach had been used. And so it was for 4 marks. And so what we say is the net present value calculation in part A include the effects of inflation. Under the real terms approach, the effects of general inflation are excluded, which will affect both the cash flows and the cost of capital. So then you explain what affects the cash flows. The cash flows which already suffer general inflation will be left uninflated. So for Elaan, no cash flows fall into this category. Where cash flows suffer specific rates of inflation rather than general rate, the cash flows would firstly need to be inflated at their specific rate, which is what we did. And then these nominal cash flows would then be deflated using the general rate of inflation. The cost of capital would be converted to the real terms cost of capital. And then the result, in the absence of tax allowed depreciation, which suffers no inflation, the net present value obtained under both methods would be the same. So that's why there's a slight difference. It's because the depreciation has been tax allowed depreciation has been deflated in this case, and it shouldn't have been. And that's why there's a slight difference. So that is understanding the difference between nominal and real. Yeah, it needs practicing. That's the point, Jeroni. You need to practice it. So, what you need to do is do the basics well. I have shown you a real exam question because sometimes it's good to see where you need to be. But all of these techniques have been taught to you on the tuition course. So inflating, using tax, calculating tax benefits, calculating working capital, it all just needs to be pulling together. All right. In terms of calculating the real way, I've taught you also how to deflate the cash flows to get to the real cash flows. So the basic thing to do in your exam, if you're asked to do that, is you just take the cash flows at the bottom and you deflate them like I've done to get a real NPV out of it, and you'll get full marks. Okay, so I'm going to end it there.